What's going on, everybody? Welcome back. We are back in the building. It's so good to be here. Live Fed Day watch party. What else more could you want? So glad to see you guys. Happy Fed Day, JT. What's up going on, Chris? Mike and I are here, and we're ready to rock and roll. What's up, Mike? What's up?
It's Fed Day, man. It's Fed Day, so we haven't had one in a while.
Yeah.
And I think it's going to be, I see a lot of people saying, "Oh, this is the most boringest Fed Day. We know what's going to happen, yada yada yada." I don't know what's going to happen.
Well, you don't know what's going to happen in the presser. The
Right.
presser is going to be interesting. I'm pretty sure if they do anything other than a 0.25% basis hike, then we're, who the fuck. But
well, I mean, look, I think 1/4 point hike baked in, right?
Yeah, for sure. It's also baked in that they're pausing next time, right?
Yeah, I mean, that's the thing. I mean, that's the game, right? So this whole rally, this whole bullish premise that we've been trading under over the last month here has been based off this premise that the Fed is done. And the stats don't say it, but I mean, look, there's a lot of things going on, right? I mean, there's a lot of things going on. I mean, we've got banks are failing left and right. But all I know is trading's been great, and we'll get into all that. But trading, we've had some really good days, except for yesterday.
Yeah, I don't think the dollar got the memo because it's been in this range for about a long time now. So, maybe something will wake it up or something. But so Forex has been, and gold, I guess everything's been just disgusting on Forex side. So I'm glad stocks have been good because it's been probably the worst month in a worst 2 months in a long time that I've seen for Forex. So.
No, I mean, look, it's been a difficult market. I mean, I definitely won't. I'll definitely, give you that. I mean, all you got to do is look at the VIX, right? I mean, the VIX is basically, headed to the graveyard. So it's been a difficult market to trade. If you've had a tough time trading over the last 30 days, I mean, it's a different market. It's difficult, right? Volatility has really kind of been it's weird. We've had 2 major bank failures, and yet volatility, the VIX, is like nowhere.
Yeah, and I think that that's what's making this probably the most interesting Fed meeting is the volatility is nowhere. We have bank failures, we have high inflation, so it's like they got to cut to save the bank, or they got to cut or pause to save the banks. They got to raise to save inflation. They got just so I don't know what's like the sentiment out there. I mean, it's a lot of moving parts right now.
Yeah, there is a lot of moving parts, but I got one word for you that's really been driving this market. You know what that word is?
Give it to me.
AI, baby.
Oh yeah, yeah.
AI.
AI train.
We're on the AI train. I mean, AI. I mean, look, this reminds me. It reminds me AI. This whole. I mean, and we kind of called it out 3 months ago that this was going to be a big deal. But AI kind of reminds me of back when we had the internet boom. I mean, it has been the driver of this market. I mean, all you got to do is look at the charts in NVIDIA, look at the charts of Microsoft, look at the charts of AI, basically any stock that mentions AI is just going to the roof.
Yeah, it's like let's put .com in our or let's put Bitcoin in our title. It's like anything in relation to AI is going to just pump it up.
Yeah, I think the chat, the stock chat at least was basically they were counting how many times AI was mentioned on the Microsoft call, and I think Mal got up to like 11 times or something like that. And then we were joking. I mean, it's like, okay, Bumble reported yesterday. I mean, did they mention AI?
They
if
must
they want to go up.
Yeah, exactly. I mean, Bumble can easily incorporate AI. Come on. So
we've had a couple drivers. It's been a weird market, and the Fed. it's been, to me, one of the most hated markets. I mean, look, I've been trading for 30 years, and all that time, I can't remember the last time a recession has been forecasted like this.
Yeah.
Okay, back in 2008, 2007, when Paulson was talking, you basically, we are already in a recession. He said he doesn't see it happening. Right. So, here we're out here predicting recession after recession and catastrophe. And so people are the most net short they've been in over the last 2 years.
Yeah. I mean, they're talking about what, a second half of the recession right now, or I read that someone is, and then someone's talking about 2024 recession, but the problem is like that's what makes it so sticky is they won't be able to cut in a recession with high inflation. So it's like, I don't know. It's interesting.
Well, that's why there's a lot of professional traders sitting on the sidelines.
Don't blame them.
Just tough. It's a tough thing. You got a lot of people, there for a while. The volume was sucked out of the market. You had some dislocations, but now, the market is, I think, now I don't know. Look, over the last 30 days, we've actually put on swing trades that we haven't done in 2.5 years. I mean, we've had over 15 swing trade recommendations, and we've only lost on 2 of them. I mean, it's, there's certain segments of this market that is roaring, and yet there's certain segments of this market that's just like, dead. I mean, it's a stock picker's market. It's an asset picker's market, I guess you could say, because you Forex people, I don't know how you're doing it, man.
Yeah, it's been a tough game the last couple of months for sure. I mean,
Chris says I got an echo coming from my
I
mic.
know it's because I told you there's a 75% chance we'll get that echo coming in. It's because Mike has the that Craigslist mic, the five below mic.
They don't let me out much, so well, I tell you what, let's head in. Let's look at the charts, man, before we get a little bit closer. 2:00 is when the Fed's coming out, and that's when we'll get some good trading action, hopefully. But let's go to the charts. What do you think, Ty?
Let's do it.
All right. Well, can you see my charts?
Yes, sir.
All right. Well, you can kind of see the action that we got today. Just kind of hanging in here. And it's kind of this V type action is kind of, what we got. You see V's everywhere. Ty, look, V, V, V. I see V's everywhere. But anyhow, this market, interesting. If you look at the SPY, what do you take of this monthly chart, Ty?
I take a whole lot of nobody knows what the hell's going on that monthly chart because there's just a lot of indecision. Clearly, I mean,
yeah, a lot of indecision. The weekly chart, the weekly chart's interesting, and you can see we've been kind of plotting our course here with these circles. Matter of fact, I think it might have been the last Fed meeting that this is where we were down here, and this is where we expected to go. Not bad. We're almost there. So if you look here, it's been 7 straight weeks of higher highs. Now, we had 6 straight weeks of higher lows, and we broke that obviously last week with some of the wild action that we had. But, you can see here, if you look, there's been some weeks where just no action. It's hard to trade when you have volume like this, right? And a doji like this. I mean, that's a whole week of action, and it can get very frustrating and get very challenging. But if you look at it, I mean, look, the markets are positioned. I mean, we're in an active sequence on the SPY. As far as my take, I think well, let's get to the 4-hour, and I'll give you my take on where I think our zones are. But for me, and you can see this nice 4-hour bar that we had on Tuesday. But for me, I'd be looking down at this 407, 408 level, and then possibly down to 403, 404 on the downside on any whippiness out of the Fed news. On the upside, I think 418, for 1850 definitely in our sights. What do you think about this 4-hour chart, Ty?
Yeah. Currently you're sitting in, like, you have almost this range here that you clearly see a lot of indecision. So not really confident about this range, but anything above this range, you had just that grab of liquidity, bearish engulfing, and then push back below. So, um, so I feel like if we do pop up, we're going to run into some clear resistance in this area here where we had that prior liquidity grab. Maybe we grab that liquidity during the 2 o'clock news. I don't think we get that breakout one way or the other until presser. But I mean, you talked about it earlier. Is you have the V where, or the break above highs and break above lows. You have the lows here broken, and you have the highs here broken. So it's just it's just a toss up at this point for me. And what I'm watching at the moment is this, what you pointed out, this 4-hour candlestick. And I'd be watching, who's controlling it. Is it the 50% area is probably somewhere around here.
No, it's right. I got it drawn.
Oh, you
right
have it
here.
drawn? Yeah, I could see it. So I'd be watching the 50% of that big bearish candle that you have drawn out already to see who's in control and which way it's probably going to head for temporarily.
Yeah, yeah. See, I'm right there with you, Ty. And I also, I did, of this range, and it's a good point. We've really been in this trading range, and if you look here, kind of maybe even look at the 50% candle of this range here, you're looking at 410.50, right?
Yeah, definitely.
Right in that range. So, there's a lot to really love about this 4-hour chart as far as giving us some markers for trading, which I think will be good, right? What do you think, Ty, as far as, really maybe having some good action here from the news?
No, I definitely agree. There will definitely be action here because if stacked levels like you had drawn out, as you have the 50% of that large volume candle and then 50% of this range here, you're sitting right on top of those stacked levels. So definitely going to see a lot of support and a lot of exhaustion. You're already seeing it from the last 4-hour candlestick, as you're seeing a lot of support at the 50% area. So definitely some levels to play off of down here.
Yeah, I'm liking it. I'm liking it a lot. So we'll see. We'll see how it really works out. If you look at the 1-hour chart, you can see even more choppiness around. You can kind of see like a wick up here as it was above the 50% line, and then a wick down here. So they're definitely keeping it kind of pinned in this range.
Yeah, I mean, at as you typically get right in front of Fed meetings, is like who wants to be the first one to buy in front of the Fed or whatever. So you're just seeing a tightness in this range, and I mean you have some range to fill up here. So that's why I figured you have some room to wick around. Okay, wick here, fill that range, grab liquidity here until the presser, and then maybe we get the directions. What I'm thinking, but we'll see.
Yeah, definitely see. 30-minute yesterday, by the way, for those that are in our room, okay, we had a great call out yesterday. I mean, and this was if you're in the Discord room, Mike's Corner, I post it every morning as far as what we're looking at. And look at this nice head and shoulders pattern that broke. I mean, this was a nice short. I didn't expect it to drop like this, but with the bank failures, and look where it found its support, Ty, right into this little ledge in here. So nice action yesterday if you were trading the indices from there. 15-minute, and again, we've already looked at where we are on the daily side. As far as tech, where the action's been, tech's been the place, right? I mean, we've been in an active sequence since March in here, and just holding the 9 in 21. We had this brief little push down into value where they found some support here, and we're right back up near highs.
Yeah, I mean, look, tech's been clearly the stronger of the indices that I know you've been talking about it, but we're sitting on top of this breakout here rather than the other indices are sitting below those highs. I mean, we've been creating just extremely bullish structure. So, yeah, it goes to tell you that maybe tech will lead the way up here,
Yeah, absolutely. It's leading right now, so
Yeah.
it's a place to be. On the other hand, bad charts, ugly charts continue to be bad. And look at this dog shit chart, Tyler.
Yeah. I don't even know what to say about that chart. It gives me a seizure just looking at it.
It does. I mean, this is obviously small caps, and small caps have been weak. They've lagged, severely, and historically have lagged where tech has been. It's just, they're really an outlier at this point and the place you want to be away from. But you know what? It's not a surprise, because when you talk regional banks, I mean, regional banks, typically smaller banks, are, that you find those regional banks in here. So that performance, obviously, the smaller banks is holding down the small caps. But if you really look under the hood, if you look at micro caps, right? They're at, like, they made a 2-year, or 2-year low, a multi-year low just yesterday. Just yesterday. So, again, look under the hood, it's not looking good. I mean, and I guess it kind of fills in with the recession thesis, uh, where, the traders don't want to be. Now, Ty, I want to get your analysis, and I know my chart's probably effed up. It has to be, because look, man, we've been in Wick City here,
Yeah.
as far as the dollar's concerned. So this looks like it wants to just completely fall off a cliff.
Yeah. First off, there's definitely something wrong with your gravestone of a chart there, but it's it's
It's crazy.
but I tell you, my chart doesn't look much better because it's just sitting in this just absolute disgusting of a range. It's really interesting though, because the weekly chart, the daily chart, they just both, the monthly chart, they look like they want to absolutely fall off a cliff. And but it's just, I don't know what's holding it up right now. I have no idea what's holding it up. But
Yeah, I mean, look, and it's not hard to see why the dollar has kind of, become not as important. I mean, heck, it was it's been almost 6 months now, maybe 4 months, since we were using the dollar tick for tick, as our guide and as our market general, for giving us some really good trades. That relationship, or at least the veracity of that relationship, has kind of gone away for us in the stock market. And so I don't even pull it up on my chart anymore, because it's just completely dead. And it's not hard to see why it's been weaker. We kind of called it, we talked about it, with what's going on in the banking crisis. Even though the money supply's been going down, you really have de facto money supply going up, because with the expansion of the Fed's balance sheet, and again, it's technically, an expansion of the debit side, right? Because they're technically putting out these loans to the FDIC, to the banks and stuff like that. But, that's why you're going to see really the dollar, because it's a de facto QE, even though they're not calling it QE. So, supply and demand dictates that the dollar, you'd expect to see the dollar kind of fall off. And it's what you kind of got right here. I mean, just ugly, ugly action. I think if we lose this 170 level, Ty.
yeah, no doubt. I mean, that 170 I've had drawn forever now, and it just keeps bouncing off it. So no doubt, once 100.70 is the level I'm watching as well.
Yeah, it would be interesting. And the other thing, when it's tough, man, in the markets, and be careful what you wish for. I mean, look at all this action that we've had over the last couple years. Whether you like the markets or not, right? As a trader, I mean, this just sniffs of opportunity in here. As a trader here, it gets tough. And so a lot of times when we've always talked about, well, hey, nice little market bear run. I mean, this has been our zone. I mean, it got back down in here. We had a nice little, bear run, and then the market, the bulls would get going when we got up into this zone. Well, and you can see the same action here. But really kind of started, at the end of last year, beginning of this year, we did have a little pop up. This was the banking crisis right here. But even with, two of the all-time, how do I say this? Two of the largest bank failures in the history of the United States, right? The only action we could get was the VIX over 30 for one trading day. Does
Yeah,
that make
that's what I don't get. Is like I don't understand what's causing the market like movement right now, because you got a little bit of maybe FOMO because people don't want to be the last one to catch the move and miss it, or you got also got these bank failures that will push it down, but VIX ain't moving and the market's not falling off. So do consumers not care that they're going to lose all their fucking money? I mean, it's
You said it, Ty. I mean, no, but not in that regards, but you said the key word. It's really apathy.
mhm.
Okay. A lot of traders, and you see it in the volume, you see it in the depth of the market books, right? You have a lot of traders that have just kind of stopped trading the market. I mean, we've had a lot of retail traders wiped out. There was a study done over in Germany about, with the ODT zero dated options, right? I mean, you're looking at like $300 million lost over the last like 14 months in this market. And so it's really gotten to the point where you have, and I'm going to share with you. Let me see if I can pull this up and share with you. I talked about it, right? But a lot of times that we haven't seen it. But can you see this chart, Ty?
Yep.
Okay, so you can see we are the most net short. Institutions are most net short that they've been in this market since 2011. Okay, so 2011, you can see right here, and I'll kind of zoom in on that chart. This is where we've been, as far as the S&P 500 futures are concerned, net short. And as we know, as we know, as a trader, that really, when you have that huge net short position and you have a lot of traders that are, just waiting for that shoe to drop, that kind of unintentionally is like kindling sitting there, and it's like gasoline getting ready to get poured on a fire. So once you get a market, right, and if we go back, and I apologize for my charts are going to get all crazy on this, but it's not too bad. Let me fix that a little bit. But if you look at this, Ty, I mean, when you get a nice little pullback here, right, and if we zoom in, you get this pullback and people start initiating shorts. Well, you see these two massive bars up afterwards, right? And they both close at the highs for the day. Well, that signifies that's huge short squeeze. Okay, so a lot of these people, get squeezed out. And of course, if you have a huge short position, there are people that once the markets go up, it's going and the action's going against them. Well, the only way to alleviate those positions is to buy and cover those positions, right, Ty?
Yep.
So that alongside that, you have so many people that have not participated in this market. Okay, you have so many people that have not participated. And if we go just with like a clean look at this chart, I mean, people have not been buying in; they've been fearful, and so it's you have a lot of people that once I really feel once the markets keep on holding, and you got this low, higher low, higher low, higher low, and if we keep on making these higher lows, that's just going to drive the fire. You got all these people sitting on the sidelines with cash, and they're going to start rushing in. You got shorts are going to have to cover. They're going to have to rush in. That's what kind of fuels this. We could definitely see a squeeze up into this area.
Yep.
So it's something to think about. Moving on, rates. I mean, Ty, what do you make of rates? I mean, rates have just, completely just, fallen off. We still got a heavily inverted yield curve, but you got the 10-year. I mean, we're getting ready to go raise. The Fed's getting ready to raise by 25 basis points and bring the target range up to 5 and 5.25. And we got the 10-year, getting ready to fall down at lows.
Yeah, I mean, it's just like you're seeing a clear like where you dip below this area and it doesn't last here long, and you're sitting here you're not seeing the price action you used to see where you're getting the driving price. And so I guess that people are just kind of settled in on their ways where where the rates are now. But once you start getting maybe a change in policy and narrative, when people actually start changing things, it's like that's when you'll start seeing the thing move out. But once it moves out of here is probably when you'll get that move, because it's just stuck. Like the dollar, the last like couple of months, it's been stuck in this range, not really moving anywhere. So,
So it's kind of, it's kind of screaming recession.
Yeah.
If you think about it, it's kind of screaming recession. And by the way, here's that chart on the failure. So, talking about the VIX, I mean, look at this. This is the largest U.S. bank failures. So over the three of the top four have happened this year. I mean, that's insane. That's insane. And so you can see why a lot of people are sitting short because, and we're not out of the woods yet. And you can see by the 2-year, and this is the price of the 2-year note. And obviously the inverse relationship has really pushed that 2-year down. And that really relates back to the futures market. So it's the interesting thing to me, Ty, is that the reason this meeting is so important, the market, if you look at the 2-year and you look at the Fed futures prediction markets, they're predicting the first rate cut coming in at the September meeting.
Wow.
At the September meeting. Isn't that crazy? So just absolutely insane. And I think, I don't see that happening at all. I mean, you got the CPIs stuck in the 5 range. You got the Dallas Fed came out and has shown that PCE, taking off the tops and bottoms, has settled in about 4.75. So inflation has kind of settled in that 4 to 5 range, which is double, almost triple where, we've seen it or where the Fed wants it. So the Fed, like you said at the beginning of the show, is in a box. Okay. So you have the economy that is obviously is slowing. The ICM manufacturing index has come in 6 straight reports in contraction area. New orders have come in 6, I forget how many reports in a row, but in contraction and declining. But you look at the only thing holding up the economy right now is the services index. But definitely, bonds, oil, all saying that we're headed towards a recession. One thing to look at that we look at is credit spreads. And of course, we look at junk bonds, and, junk bonds kind of holding in here. Credit spreads kind of holding in there. They have moved a little bit, but nothing to say that we are an immediate crisis of liquidity. But what about oil, Ty? I'm going to let you talk about oil.
Yeah.
I have my own thoughts. I've had a pretty good run on oil, and I don't even trade the damn thing. But give me your viewpoints on oil here.
Yeah. So clearly it's just been, again, I mean, the moral of the story here is everything's been stuck in this range since the beginning of the year, which is why Forex and commodities have been just trapped. But with oil, you have a lot of interesting things. Like we had this nice rally here from all of the, with that gap. We had that huge gap a couple weeks ago, and then we filled that gap, and now we're pushing below very, very, very important levels. And I think that what you're seeing now is a lot of weak demand. You're seeing oversupply, weak demand. I mean, the gasoline inventories rose, crude inventories rising, so the demand's not there. Russia also kept talking about how they're going to cut production and stop exporting some oil, but they haven't, and there's still high exportation and a high production. So a lot of, I guess, news pieces that were supposed to come into effect and lift the prices really just kept it in a hole, and it's now dropping. But it doesn't help that the dollar also stuck in a hole, because it's something that would actually help drive oil prices, one way or the other. But now it's just stuck. So I mean, if it breaks, I told people yesterday, if it breaks below 72, we're going down to 66, and we're at 68, and I still think we're hitting 66. So I still see a continuation of the downside.
Well, you know what I love about talking to you about oil, because I don't trade it and I treat it like a stock, right? So, and you guys in the commodity, it doesn't really work typically, right? But what I love about oil is I've been focusing in on this 100 moving average on the daily chart, right? And again, this is the oil futures. And nice rejection in here, nice rejection in here. And then you get on the OPEC decision, you get this gap up. And what I told my guys is I said, look, the 200's too close. It's like a magnet. Let it hit the 200 and come back in and see what it does with the 100. And that's exactly what it did. It went right up, magnet to the 200. And then look what it did. It kind of settled for 3 days at this 100. And then when I saw this, that it was below, I mean, it just looked too easy to me just to take this short. Now, I don't trade it, and there's nuances that, I don't understand, so I stay away from stuff that I don't understand. But just treating this like a stock, I mean, perfect technical action.
Yeah, no, it's great technicals. I was just, so it's funny because in this whole area here, because I play heavily off of like, I tell people
Mhm.
what's happened before in this area and expect something similar. So I said, look, if price comes down into this zone, I'm not going to buy. But what you typically see is maybe you see an exhaustion bullish candlestick, then a run, exhaustion bullish candlestick, then a run, exhaustion
Yeah,
bullish.
I would have
So
took that.
yeah, so clearly, you don't buy here, but I said if it gives up 72, then we're selling off. But if we can see a bullish candlestick form, you might get another run again stuck in this range. And it clearly didn't. So it's just, sells away. But there was no entry. Like when I was looking at the chart today, I was like, yeah, oil might sell off, but it just went straight down. Like no entry
Now,
for me. So
well, that's the thing, and that's a great point. Like, if I was trading this and this was a stock, that's what I would have been looking for, a nice little wick, look below, and then go, right? Because this is a natural area right here. But now, I guess if you're trading oil, I guess you got to really focus in on this zone in here, right?
yeah, no, exactly. That's exactly where I was looking for price to maybe find support. Look, 60, if it doesn't find support at 66, because this is an area that we've been finding support since like 2017, maybe 2014 even. And so I think we find support here unless something crumbles. Look, OPEC even came out and said they're monitoring oil prices. So that could be enough in itself for 2014 levels to actually hold here at 66. So definitely watch the 66 level. Now, I'm not saying buy because it looks so weak, but
Mhm.
if you do see some bullish candlesticks form, you've seen where we've seen some heavy sell off here. Bullish candlestick, you find support and you rally, right? Same thing over here. So I definitely would keep an eye on this area that you just drew out, the 66 area, to see if we find support or not.
Man, I may want to buy this myself if we get little support in there. It's looking nice. So we'll see. But don't try to catch the falling knife,
Right,
right, Ty?
right.
All right. Commodities, Dr. Copper kind of falling off a little bit down here. It's interesting. This is at an interesting point. So commodities just look like they want to fall off here. In sectors, I want to talk sectors a little bit. Being a professional trader, you're always looking for who are the market generals, right? And what I mean is, typically, we tend to strive towards big cap tech, right? Apple, Tesla, Microsoft, Google, Amazon, some of the stocks like that. But over the last really 3 weeks, it's been banks. And I can't remember the last time banks have been our market general, but really the market goes as banks go. And, XOF is not the banks we're talking about. See, XOF is the big cap banks. This is the Morgan Stanleys, the Bank of Americas, the JP Morgans, right? And as you can see, banks during this banking crisis did take a nice little hit, but they have recovered some. They're still weak and they're kind of sitting on this ledge, and something to watch because look, if you see, and I can tell you this, and this is how you use these generals, okay? If you see big cap banks, you see XLF start rolling over down towards lows, you know you need to get out of the market. Just straight out. I mean, if the big banks start rolling and start having issues, you need to get out of the market right now. They've recovered, kind of hanging in here a little bit. And yeah, they're weak as expected just because of the tightening of the credit conditions. But right now, kind of holding in here. But the banks that we're talking about from a market leader standpoint is this KRE. And I can't tell you how many times I go on Twitter, man. And Twitter just, it amazes me how many times I go on Twitter and I see freaking people, oh, it's time to buy the dip. Look, it's getting up. It's time to buy the dip. How many times you see that, Ty?
Too many times.
Yeah. I mean, it's like, look, this is an active sequence down. You got the 9 and the 21 EMA as lids. And it was just a matter of time before this small level broke. And so if you're wondering why the markets had a tough time yesterday, well, it's because what happened? You had these regional banks sell off, Because Monday, it's kind of the aftermath, right, of the First Republic. First Republic got taken out Monday over the weekend by the FDIC. And so if you look at these regional banks, right, like Valley National, look, when you see action like this in these stocks, it was a good, signification or a good indicator that you probably want to get out and be careful with the market because the market's scared, man. It's looking like, look at this. Look at Pacific West, man. It's looking like they're the next to go out. And there's been some great YOLO guys. Guys, I gave out this recommendation right up here last week. I said, look, if you guys are looking for, and actually, let me go to the 1 minute chart. Okay. If you guys are looking for, a YOLO play. And Ty, how do you describe a YOLO? Just like a lottery ticket, right?
Yeah, like, hey, I don't want this money anymore, but I think it'll be fun to watch.
Yeah, it'd be fun, right? The problem is people actually make their trading their YOLO. They treat trading like YOLO, but there are actually YOLO plays that have good odds that you might want to take. One of these that I recommended was right back here. When FRC was kind of breaking down, it was breaking through 12. The 12 puts at that time were going for under a buck, Ty. So within a week and a half, you only live once. That's true. I love that. I've never heard that. Anyhow,
what it stands for.
I didn't know it stands for that, man. I thought, what do I know? I'm a fucking old guy. But anyhow, I said, look, I'll put it out in Discord. I said, look, these puts are going for under 12. Under $1. Why not? And guess what? Where'd it go? 0.
Yep.
So it cost $80 to buy one put. Okay. $80. And you made $1,200 off one put. $80 to make $1,200. Imagine if you bought 10 of them. $800 to make 12 grand.
I know you're getting my buddy Junior excited because that's all he did. This guy said so he's a big options trader, the guy who I trade with, and he said he does options, and he was talking about that as well, and he was talking about how you can make like 800% off of just like these quick moves like that. I'm like,
and great point. I'm glad you brought that up. Look, with the VIX down here, typically 90% of the option winners are the people that are writing the options. Mm-hmm. Okay. And a lot of retail traders do not understand options at all. And so what happens is they buy options going into earnings, and then the stock goes in its direction, and they wonder why they didn't make any money. Okay. Because there's something called implied volatility. You get sapped out of that. Well, on the flip side, though, when VIX is this low, you really don't want to be, because that really is tell you the implied volatility is low in the premium on these options. This is the time to be buying options, right? This is the time to buy options because if anything, it's more likely got a good chance of going up, which means even if your stock or asset doesn't go as much in the favor, if it just the volatility itself is going to increase those premiums.
Yep.
From the implied volatility standpoint. So yeah, look, great opportunity to it limits your risk by being a buyer. You know what your downside is, max downside, and it gives you great opportunity to make some money, man. So really good. Before I get into stocks, I know Mo wanted to talk about AMD, and it's good to see you, Mo. I love it. Look, for those of you complaining there's no trades in this market, okay, I want you to look at these sectors. And Ty, because you're not a stock guy right now. You used to be. You went over the dark side. You tell me when I pull up these charts, bullish or bearish?
Yeah.
So, home builders.
I'm going to say bullish.
You think? Healthcare.
I'm going to say bullish.
Yeah. Medical devices.
Bullish.
Look at these sectors, guys.
Bullish.
Consumer staples. Man, there's a lot of bullish charts in here, huh?
You haven't given me one bearish yet, man.
Semiconductor.
Bullish.
How about defense?
Bullish.
How about leisure?
Bullish. Where's the recession at, dude?
Okay. I'm glad you asked.
Ah, there it is.
This, you know what this is? This is EV
This is
land.
what Mark bought, isn't it?
This is EV land. He's trying to get me to buy it. Okay. Retail.
Yep.
Okay.
Hmm.
I already showed you obviously banks.
Yep.
Solar.
Nope.
Okay. How about China?
China. No.
How about marijuana?
No. Oh God.
How about the shitcodes that were roaring at the beginning of the year? ARC.
Oh. Nice.
Poor Cathie.
Fuck.
Real estate.
Mm.
How about cybersecurity that was so hot at the beginning of the year?
Yep. Hot and then not.
Yeah. So I mean, look, there's action in this market, in these markets, guys. There's action, right? I mean, you know, again, and you know, I know Mark is doing a YOLO on Rivian, but guys, look at these stocks. Okay, look at these charts. LCID, Rivian, Neo. Okay, there's so many of these charts. I hate to tell you guys, they're going out of business.
Dude, no stock that drops like Rivian is going to recover and not go out of business. Dude, look at that. That's just disgusting. If somebody asked me, hey, what's some of your top picks right now that you want to buy? I mean, Rivian would be last on my list to buy. I don't know why you would even YOLO something like that.
Well, you wouldn't, but, you know, some people do. What was Hertz's ticker?
Yeah, that's it.
Yeah, that's it. I mean, they're now back reincarnated, but I'm just saying. I mean, these stocks. You know, again, we don't know which stocks are going out of business. I mean, the Saudi nationals. If I'm buying a stock, you think I'm buying Rivian? If I'm going to YOLO one of these stupid charts, you know which one I'm YOLOing? This one. You know why? Because the majority of the float, there's a big is owned by the Saudis.
There you go.
So I much rather be in this bullshit stock than, and I'm not even going in that one, than this one. Or this one. So I mean, just be careful. I mean, charts like this are like this for a reason, right, Ty? We always say that. Charts like this are this for a reason. So and we called out, look, AMD, okay, AMD and NVIDIA have been coupled for a while, but starting back in March, they decoupled, and there's one word. It's called AI, okay? So NVIDIA, look at this NVIDIA chart, Ty, okay? Retail traders are so afraid to buy this chart, okay? Because, oh, it's already went up. I want a discount. Well, here's your discount.
Right.
Oh, it's already gone up. I want a discount. Here's your discount. Here's your discount. Okay. I mean, look at this monthly chart. I apologize about the lines. It's almost up at all-time highs again.
Yep.
So good charts are good charts for a reason. You know, Microsoft is now an AI play. Look at this chart, Ty. It's got kind of like a triple top, right? But look at Microsoft's monthly chart. Same thing. There's strength in this chart, and there's, you know, just, you want to talk about a stock that has AI at the end? Look what it did. Went from 2 to 20.
Oh,
just
my
because it's
God.
AI. So anyhow, there are some plays. AMD. Okay, I know Mo wanted us to look at AMD. AMD's cracked. I mean, I would buy AMD possibly at 79.45. What's your viewpoints on AMD? And I'll get rid of this this little.
Yeah, I mean, you got like.
You're muted.
Yeah, I just realized that. There's fucking. I mean, I think rounds where you have it, that 78.93 is probably a decent area because you have these ascending lows in here that we could potentially come and intersect with that 70, 78, 79 area. You have this top that you have drawn here, this lid here. So it's an area that you've seen buying before. If you look prior here, it's where you saw the run up. If you look prior here, This is where you saw a nice run up. So it's an area that gets bought. It's also the 200. So if I'm buying AMD, it would definitely be right around 79. And that if it cracks 79, then I would not even consider it for a while.
Yeah, I think so too. That's great. Great analysis. I didn't see the 200 sitting there, and so that's you just got too many areas of confluence. And the reason that works, by the way, and it's so simple, but people don't think about it. It's because you have traders that are looking for the 200, right, Ty?
Yep.
And then you also have traders that are looking for this level, that just trade off levels. And then you got traders that are trend line traders.
Yep.
So what happens when you got three different areas coming in, you got three different types of traders that are going to be at the same, looking at the same spot, but they're looking at different things. So really nice. I'm not sure what happened, by the way. And one stock that we've been, and this is a perfect example. And I don't want to talk about the trader used to recommend this one, right? But this stock is kind of like, this is the example of a stock that kind of is really kind of puts trading in its perspective, right? If you look at Meta, nice bullish run all the way up here into the really middle of 21, and then it cracked, and it's a broken chart, right, Ty?
Yep.
You had this huge gap down, and then you don't try to catch the falling knife. I mean, look at this active sequence. You got the 921 and the 50, just as a lid for like a year. Then look what happened once it basically capitulated down here, got almost down to book value, and then what happened? Traders came back in, and now look at the active sequence to the upside.
Yeah, because then what you do is instead of getting paper cuts on the way down, you wait for these higher lows to start forming. You get a change in market characteristics here because you're getting constant lower lows the whole way, and then you get a change in market characteristics where you're now getting higher lows. We break through this top here, and then you get that run through. So it's just all about being patient. Patience is what keeps traders from being successful or not.
Yeah, I mean, look, I love. Once you get this active sequence to the upside, I mean, just buy. I mean, look, just buy. It doubled. Meta has doubled since it started its active sequence here.
Yep.
Sorry, I didn't really. I had you. I was doing a lesson for Mark here, and I said, "Here's where Mark gets in. Here's where Mike gets in." So sorry about that, Mark. Didn't need to leave that on there. But anyhow, we're just trying to teach you guys, man, and that's really important. Now, Mo wanted us to look at EL. And ugly chart. So obviously it had earnings, I'm assuming. I mean, this is not good. They're buying it up, and they bought it off 200. They're kind of, let's look at the monthly chart first, and then I'll let you give your analysis on it, Ty. Monthly chart, not as bad. I mean, you're kind of getting, you're kind of getting some buy up off this zone. So I don't want to see. I mean, if I'm buying here, I don't want to see these lows broken. What's your thoughts?
Yeah, you're also running into in the month you're running into a area of support here on the month where you can back from 2017. You're now running into these lows. You're also running into the area Mike talked about, which is this where you saw all of that exhaustion, and then you saw that breakout. So this is the area 200 that it has to hold if it's going to hold up. So I mean, if you're going to buy, Estee Lauder, then this is where you want to buy it. But I'd wait for a little more confirmation before I just jump into a monthly bearish candlestick like that.
Yeah, that's a good point. I'm glad Mal's in here because he's our resident value trader. Yeah, I mean, you can see it's still at a 60 PE. So. I mean, it's tough, man. It's tough. I mean, it's a tough stock. It's a tough place to be. So it has come back down into value there. And I mean, it's a tough stock. A lot of these value stocks have become. I mean, look at Lilly. By the way, we recommend right here. We recommended a swing trade in our Discord room right here. Okay. Of course, Mike doesn't have patience to hold all that if he was in. Merck, same thing. We had we had some nice call outs on the swing trades. But problem is, a lot of these value stocks, they're now becoming, overvalued stocks. I mean, look at Procter and Gamble. And what's interesting is, you look at like some of the lithium plays that have, this stock has a PE of, I believe, 8. Okay, which is a lithium play, but because of the sector it's in, it's like getting slaughtered. So it's kind of hard right now. And you just got to be careful because we're not out of the woods, but just like we saw, eventually this growth mania is going to switch back to value, and Mal be happy again. And then everybody will be rushing into their stocks. But look at Coca-Cola, look at McDonald's. Okay, we recommended the buy rate in here. Look at Starbucks, okay, getting pulled back on earnings, but I mean it was at 52-week highs. Look at Procter and Gamble. I mean, just look at these stocks where they're just, they're all running away. I think, yeah. I mean, wait for a little. If you're looking to invest, wait for a little bit more value, maybe.
Got 2 minutes left.
All right, 2 minutes left. I'm gonna stop sharing. I'm gonna get my chart set up here. And as we get prepared, now remember, there's not much surprise in this event. I mean, we're pretty much going to get a quarter basis point, 25 basis points. I think it'd be shocked if we got nothing because of the bank failures that happened since the Fed had their meeting. We had another bank failure. You have the debt clock. We haven't talked about that, Ty.
That's right.
We got the debt clock, inching its way up here. We have market now expecting a rate cut in the September meeting. And now, by the way, since the last meeting, Powell got zoinked by Zelensky. Did you see that?
No, I didn't see that.
Yeah, they're like an influencer saying he was Zelensky, and Powell did a meeting with him.
Nuh-uh.
Yeah.
How does that even happen?
It's called not vetting. That's called nobody wants to work and do their due diligence. What do I know, man?
What the fuck?
I'm just a dumb trader, man. But I'm trying to get my charts ready because it's going to be...
Oh, yeah. Everybody take your piss break because the next hour of trading is going to be fun.
All right. So I can kind of share this chart, Ty.
No.
No?
No.
Okay. I won't.
No.
Well, you're going to hear a bunch of order fills. Order filled.
Order filled.
I better switch to the lower contracts, don't you think? Oh my God, where is it? Oh my God, see, this is what happens when I do this show.
Oh, Jesus.
Your fault.
40 seconds. But yeah, you're probably not going to see much movement with this, like Mal said, up and down, sideways. But the big talk's going to be at 2:30. The big movement, the big move.
Absolutely, completely agree with you guys, 1,000%. All right, less than 30 seconds. FOMC Fed Day. Mal's predicting up and down.
Yeah, surprise, surprise. All right, baby. Give it to me. 8.
So what's the algo,
7,
man?
6, 5, 4, 3, 2, 1. Oh my God! Look at the price. Oh my God. Oh, oh my God. Oh my God. I'm looking at gold. It's funny.
Taking a couple yellows. Oh, look at it. Go, baby. Go. Wow, I didn't think to make that. YOLO. That was awesome.
I should have bought.
25. I did buy. 25 basis
Came in
points.
right in line as expected, so I'd expect this to come back.
You think? Man, that was crazy seeing that thing just.
That's actually a bigger push than I thought it'd get.
Well, look at gold, Ty.
I'm looking at gold, yeah. Dix is coming down to Chinatown. China.
All right, guys, this is not the main event that we want to trade. We don't want to kind of get, wrapped up into this yet. I did shoot my load when it kind of popped down here and then rode that all the way up for 20 points, Ty.
Chop my load. And Chop City, here we go.
Yeah, Chop City, here we go. I'll maybe risk some of this on a little buy here.
Let's just all fuck around with the charts today and see if
Come on.
see what we get. Why not? Let's just. You know what? I have a proposition. I will buy a shit ton right now, and you sell a shit ton, and one of us will win. So.
The problem is, though, with stop outs, we'll both lose.
Well, that's why you don't have a stop. You just let it go. Like JT said, coin flip time. All right, we got it. We got this. Gotta get the coin out and start just trading the
coin flip time. All right, very muted reaction for a Fed here.
Yeah.
So not. I mean, look, we didn't even pierce VWAP in here. But I'm very happy with where my account's sitting right now. I'm trying to read through and see if we can get some stuff. If you guys see any, post in the chat if you see anything that is of note that you see in the report. They did take it up to 5 to 5.25% target range, just what we expected.
Yep. I'm going to get a snack real quick, maybe some popcorn. So I'll be back in 30 seconds while we chop around in this range.
You do that. So gold, look at that big stiffy bar in gold, guys.
Well, Mike is a little soft because he's a fruitcake, but no, he's looking away from the mic, which is why he's soft. So.
What do you mean I'm soft?
This chart didn't get him that excited, so he's soft naturally.
Man, I'm waiting for the main event here. Would like to buy down towards the point of control here, maybe. But I mean, just really not seeing. I mean, we're leaning to the upside this action prior to what we got going on, but I got to make sure I hit the flatten button too. Yeah, they're leaning to the upside in this right now. I mean, it's almost feels like they are having a hard time. Sellers are having a hard time pushing this down. There's the point of control. So got a little into the point of control, into VWAP. I might take a little trade here. See what we see. Oh, there we go. Come on, let's go. There we go. All right. We'll take that. I'm not sure. I'm having some issues with my trading software. I'm not sure why that was, but all right, not a bad start to the day. Just not really doing a lot of trading yet. We wanted to establish ranges, draw our Fibonacci's going into the event. We always like to trade live here. But I did buy. This is what I was looking for. I was looking for a drop. The point of control, 41.43 on the ES. We had VWAP same way. So I bought this, and it kind of went up here. So, it was nice getting like a 7-8 point pop on the ES at $50 a point is not a bad thing. But definitely, right now, what I always tell our traders, you always want to look to see who's in control. Okay. You always want to look to see who's in control. Are the buyers in control or the sellers in control? And here, clearly, with the statement that's been put out, I mean, the expected statement, obviously, buyers are in control. Sellers, they can't even, we've yet to have a bar close below VWAP. They couldn't even push it down. I mean, they can't even fake it down this way. So buyers clearly in control of the ES right now. Sellers definitely the weak hand. So that's something you want to kind of make note of. And here you got the 200 as well on the 2-minute chart. So not bad. So, but again, we still got about 20 minutes until the next press conference comes up. Let's see if this is. I'll take something here. Let's try it again. Are they going to give us the trade again? What's great is when you have profits, you can take a couple. What's it called? YOLO trades, Ty?
That's right. YOLO, baby.
Yeah, let's go. Come on. Pop up. I'm loaded up. Pop up.
You won't load up more.
I'll take that. I don't know. It's going to go up. So, all right. Just sitting pretty good. Again, bought out of here, bought out of this zone here off Monday's low. You know, we're above that 50% level, Ty. That's a note, right? That 4-hour bar you're talking about.
There we go. Yep. That's something
You're
I trade
muted.
off of. All right, all right, I'll buy, I guess.
You're muted.
Well, I'm muted for you, not them.
Okay. Oh, I'm
Yeah,
sorry.
you don't need to hear me.
No, I hear you all the time. So look, this is I tell you what, gotten some nice action out here, Ty. So this has actually been better action than I expected.
Grab a couple points out of it. Grab some few points here and there.
What if Theo said? Theo says, I like Mike's other side.
He likes your back side, not your front side.
Yeah, I don't either. I don't like my front side. Red line text in the chat. What's that? Let's try to catch up.
What? Red
Nah,
line
just read it.
text in the...
Oh, okay. He put it in Discord. Thanks, Mal.
Oh.
See, we got some of the best people in there, man. Federal Reserve issues, FOMC, stay. Yeah, so they pretty much economic activity expanded at a modest pace. So they added that. Jobs have been robust. No shit. Okay, so they did get rid of the statement in order to attain a stance of monetary policy that is sufficiently restrictive. This is looking pretty dovish here, bullish for the markets. So we were looking for the restrictive to be kind of taken out. So I got out of this long trade a little too early. I hope you guys yeah, ongoing rate hike talks removed from FOMC statement. So this is nice. I like this. So, Mo, you still in here? Is any other stocks? Did Mo want us to look at any other stocks? I know that Meta, before right as we were coming on the show, had a huge sell program come in. I'm not sure if anybody knows what this Meta sell program was. Nice buy up out of it, but that's a pretty good drop for Meta, Ty. I didn't see any. Oh, I think I know what it is. I think Mal put it in. There's more talk of the Senate doing their thing, banning China and shit like that. And I think FTC came out with a note. And again, I think Mal put in Discord the note, or Born Alarm did. One of them. They're both good like that. Put in there that their FTC's going to start restricting some monetization stuff. So that's definitely negative. Yeah, double whammy. Yeah, that's tough. So I got what that was. But man, look at that. Look at that sell-off, 8-point sell-off on that. But anyhow, I'll tell you what, this has been a pretty good. I know we're waiting for the Fed, but I've been doing nothing but buying the point of control, Ty.
Yeah. You should buy and hold and then assume it goes up.
Oh, no, man. Weak hands.
Diamond hands, baby.
That's a young man's game. Look, when you get to the period and you trade through the markets I traded through, you got PTSD, okay? That's why I'm so good at talking traders off the ledge, because I've been on the ledge.
Oh, that's great.
I'm on the ledge now myself. You kidding me? So I'm just looking to see if I want to pop in again. At some point they got to flush it lower at some point just to shake the buyers out of their tree. I mean,
diamond hands.
Don't you agree, Ty? I mean, buyers completely control this thing.
I mean, it's clearly in bullish control right now, above the 50, above VWAP, of just all its exhaustion wicks. So I would think that you would get a flush as well, and then it goes up, because it's not going to go up with everybody holding on to their longs. So
right. If you guys have learned anything from us, the market's set up to inflict the most pain.
Amen.
Okay. It's so true, man.
That's why traders have like years taken off their life, because they're just always in so much fucking pain.
All right. Mal bought some calls to make sure we go limit down toward the
Yeah.
Okay.
All right, I guess I'll take some shorts now. I love Mal. Oh man.
Mention like a true trader, right? All right. Yeah, I tried to.
Mikey tried to buy off of VWAP. It didn't work.
Yeah, and this is the flush we were expecting, right? I
Right.
expect them to run this candle here. What do you think, Ty?
Yeah, without a doubt. It's going to run the wicks. Probably run the low from back 12:18 p.m. like the prior hump.
I would love them to run it down here.
Yeah. Oh shit. Yeah. I mean, I would too. Then I'll take some longs with you.
Shit. See this right here. This is a 5-point run. Almost.
Yeah. Broke the wick. And now we rally, baby. Oh man.
Look at that, man. It's I'm surprised they technically did.
I thought it would go low. I mean, yeah, they technically did. I thought that that like 12 o'clock low that you have like the to the right, like up left, yeah, that low. I thought they'd run that low, but
that's good. Yeah,
I guess not yet, at least.
Well, I'm waiting. You see gold, man. That was a nice YOLO up into the 20.
Yeah, I should have taken it. I want to see how many people blew their accounts on this challenge here.
Yeah, Tyler's doing a challenge, so I love it.
Let's see.
I'm already out. I tried.
Yeah, all you do is you just a bad YOLO where it's fine.
I am a bad YOLO. I have weak hands.
Wow, 1,000. Yeah.
I'm a scaredy cat trader.
Yeah, you're not.
That's why I've been able to stay in the game.
That's why you see this generation's like I had one of my guys I learned from. He'll make $1 million in like a fucking couple of days because this generation's like got balls of steel, and we just. Oh man.
You can when you're younger. Wait till you go through a couple more bear markets.
Yeah. Well,
and they beat you down. Then
they beat you down. You lose all morale, and you're just nah.
Yeah, they beat you down. Oh, been some stuff, man. Been some stuff. So is Mal still in here? Bravo Mo? I'm not Mal. Mo. Is Mo still in here? I can't see. It's been a while since I talked to Mo. I just want to know if Mo's in here because I got a question for him. Yeah, there you go. Can you look at draft? Okay, first thing, Mo. You got to give Tyler's twin sister props, okay, because she's graduating from med school. She got matched in Cincinnati emergency room. So there's a doctor in the family. So Mo, you gotta give her some props, man. We got a doctor happening, Dr. Gabor. So yep, she's gonna be in Cincinnati.
Yep, Dr. Gabor.
Dr. Gabor. All right, so DraftKings. Mo wants to look at the bullish DraftKings. I can tell you that's what it is. It's freaking bullish is what it is. And going up by the minute. So what do you think of this chart, Ty? Let me pull up the monthly chart in here. Actually, let me go back to a daily. Let's pull up the monthly. So give a little bit more perspective. You can see the monthly. So what's your take on this monthly chart here on DraftKings?
Yeah. So I definitely am curious. This is an area where you've seen, and I don't know, something must have happened because this is a pretty fucking strong bullish month. But in this area that you're running into now is where you had that volume. So this is an area you're either going to get you clean traffic looking left, clean traffic, very strong bullish candlestick. So if we can get through here, I think you have a good run up, good run, but it just depends. We'll have to see if it gets through here or not.
It's just hard because it's gone like 120%.
Yeah, right.
From where it was. So, the chart's obviously bullish. today, by instance, it kind of pulled into this candle here, which is kind of cool. That was a nice little dip buy opportunity today, possibly. But I don't know, man. It's hard. It's hard. 120% run. It's hard to buy into it. Like it's running into traffic now, right? I would think that wait for it pull back a little. I don't know. I have a hard time buying stocks that gone up 120%. I just they can keep on going, but to me, the time to buy was a break on this. This is when I would have bought DraftKings. So you have a nice little trend line right here, and I did not, obviously. And see how you got the active sequence going, Ty?
Yep.
So nice buy here, 14 to 22. I mean, that would have gave you a nice little run, and I think that would have been cool. Yeah, I thought that would have been cool. But I guess it's going to keep on going. If anybody else has a thought, Mo or Bornalam, if you guys have any thoughts on DraftKings, let Mo know. I mean, let Mal know.
Mo.
Mo.
Yes, Mal.
I give up. Let me go back to trading ES, please.
Oh, look at that.
That's all right. That's what we said, right? That's what we said is going to happen. Somebody asked me what's going to happen in the Fed today.
That's what's going to look like. Yep. Well, look at that rally. You missed that rally.
Hey, Mo, gotta get right. Thanks a lot, bro, for the 19.
Oh yeah. I guess I'll have to give that to my sister.
Yes, and that is going directly to her. So, that's going directly to her. Great job. Thanks, Brady. And if anybody doesn't know, Mo is a doctor himself in it's Chicago, isn't it?
No.
Detroit, Michigan.
I don't remember. I think something like.
I always get him and Bornalam confused. I know Bornalam.
But no, Bornalam's right.
Yeah.
I don't know. I don't even remember.
Yeah, Mo's in Michigan, and Mal, his counterparty, is in Austria.
Austria, yeah.
So we got a good diverse group.
Diverse.
But also kind of accounts for why Mal's so constantly pissed off. All right, we're getting close to Fibonacci time, Ty. I'm going to draw a couple Fibonacci.
Yeah, baby, give it to me.
I'm going to draw this in here. We probably missed our opportunity. Forgot to draw it out. We're at the 50% rate now, Ty.
Well, we were.
Well, we were. Look, they said, okay, well, Mike drew his Fibonacci's. It's time to get out of here before. Yes. Yeah, no, Bornlam's in Chicago. Mo's in Ann Arbor. Yeah, Theo, this is some good trading, isn't it? We've given ourselves a good market to trade. And look at this. As soon as I drew this Fibonacci, we just exploded out of here for 5 points. Come on, back. Oh, Ty, get ready. Can you pull up the
It's up.
Conference call ready?
It's up.
Oh, it's up. Look at that, man.
I'm on top of the game, motherfucker.
Well, at least somebody is. Nick was supposed to be on, guys, today, but for those of you who don't know, he just had a baby, his second baby, and just last week. So Nick had his second baby. He's coming back into the mix. He's coming back into trading, and he was supposed to be running this show today with us, but some last-minute hiccups, of course, with the baby.
And here I am.
And he ditched us. So it's me and Tyler.
Lucky you guys.
I bought this 50%. Let's see what happens. Hi, can you tell the market to go up, please? Just go up 5 points. I'm only asking for 5. I got to remember to flatten my orders, though. Flatten is a good word when you're trading.
Flatten. Cancel.
I want the market to go up. I don't want to be playing down.
No.
I want profits.
No.
Also, I mean, this 41.50 has been a really decent gamma level. So 41.48, 41.
All right, guys. Mike bought. Let's all bought. Let's all buy.
Decent gamma level. I did buy. I'm in. But, I'm also playing with profits. Extreme profits, Tyler. Look at the rates, though. Rates are starting to climb.
All right, I'll short the market.
Look at the dollar. Looking at gold. I added more. If it fails here, I'm out. I'm going to wait until we get closer to...
Oh, man.
Because I don't want to lose my extreme profits. There. Let the rest run. Come on. Hi, I need your expert advice. Should I sell?
Look, I was thinking, I can't believe that it's going up because I was like, well, heading into
victorious. Sorry.
Oh, man.
And as you know, Piker Mike sells way before it gets up to the top. You got another 10 points. See? What'd I tell you?
Jesus.
See? I told you. Mikey sold here at 57. It went to 60. So you got another 7 points. It's amazing how this... I got this echo. It's amazing how this 50% level works. I mean, just amazing. And you guys saw it right there. You see my orders pop up on the screen. So, nice buy down here, guys. Added when it retested, and I sold up into this level right up in here. So, not bad. Not bad. And again, I'm waiting for the presser. So, what do you think is going to happen with the presser, Ty?
Dude, oh, God. That's the golden question right there because I just want to know. I don't know. I feel like it goes up just because the entire just like market's been just ripping. The dollar is on like teeter break, like fucking fall off mode, and we're on a potential breakout here where we broke structure recently. So I'm like, well, structure looks like it wants to break out, but obviously if the Fed comes out and says, well, something stupid, then I don't know what they're going to say about the future rate hikes or whatever.
Well,
so
yeah, I mean, that's the key, right? And that's the questions he's going to get, and that's what we're going to have to really trade off of. But I would think typically we kind of run going up into the presser. I don't know, man. I kind of think this time because there's so much risk in this presser, I would kind of think we're going to pull back going into the presser a little bit. I don't know. I just right now I'm seeing NVIDIA, which is one of our leaders. NVIDIA. Let's see, what's NVIDIA doing? It's still running, not pulling back at all. Strong. I mean, NVIDIA's a beast. I mean, you can almost make 7, 8, 9, 10 points a day trading just NVIDIA. I mean, seriously. It's Just nice. Well, look at this. This 50% level is pretty important from way back when, a swing level. Nice little pullback into here, pulled back into that 61.8% from this 50, and we're getting a nice little flag and bounce out of here. So I guess I missed an opportunity there. I like this action though, Theo, because this is so, it's not whippy at all. It's so tight and it's so clear who's in control. What you say, Ty?
Yeah, no doubt.
Yeah. So about a minute, I'm going to hand it over to you. Rates are running now. Rates are not running, but they're popping up a little bit off their lows. You got the dollar popping up a little bit off their lows. I guess, think again, all in anticipation of the presser. The one stock mode that I was kind of, thinking about doing the swing position, pen starting to get going. I looked at the reopening plays, right? You can see the daily chart. You're still below the 200, which I don't like. But, it's a value play compared to LVS. These are at highs. Look at these casinos, Ty. I mean, LVS, Las Vegas Sands, Wynn, they're all at highs. So, one of the, new swings that we're kind of looking at was Penn, because it's, kind of playing catch up a little bit, but it is still below 200. So it's a no-go for me right now.
Well, people realize that they're heading into a recession, fucked either way. So they're like, let's take our money to the casino and see if we can get rich.
I tell you what, I don't know where a recession is.
Right.
Everybody's saying there's a recession, right? You go out and people are buying shit left and right. I went on a cruise 6 months ago. I mean, the cruise people were insane. I mean, the airports, every time I fly, you can't get a seat on a plane. It's like the airports are jam-packed, crowded. People are traveling everywhere. I fail to see where the recession is.
Yeah.
So, I mean, I know I've become a hermit, but seriously, man, I just don't see it myself. I'm going to let you share and get the other stuff queued up here.
All righty.
Then that way we can kind of roll into this presser and see if we. But no, seriously, man, I just don't see it. I don't see it. So I mean, I know we're having some issues, and manufacturing's kind of pulled back. The Fed's in the corner though, man. They got this. You got inflation sticky. If you looked at this today's ISM report today, services, the export number in there was strong. So if they're going to start buying exports, that's inflationary, which is going to be a problem for us from an inflation standpoint. So inflation was strong. I mean, excuse me, exports were strong. So I think that could be an issue. I don't know. So what we're going to look at here, and Tyler's going to, you shared the sound, right, Ty?
Oh, let's make sure I did. Good question.
So what we're going to be looking for, any mention of rate cuts, rate pause. I mean, the market is pricing in their first rate cut at the September meeting. So I don't see that happening at all. But we did just have a bank failure again, the second one, or the third one, I should say. And we got more teetering on the edge. So I'm going to kind of let this play out. I'm not going to pop in, waste some positions in here until we start seeing what's going on in this presser. So, did you make it so I could hear it too, Ty?
Yeah, it's just not, there's no volume yet.
Okay. Warren blames Trump for the banks. That's funny.
Let's go, Jay Powell.
Yeah, buddy. Here we go.
Good afternoon. Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in March, total PCE prices rose 4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
Now we're getting some action.
We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
Wow.
We at the
That was a
Fed
nice
will do
little
everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
That was a nice ride off the bottom.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation at 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is so. Let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel. Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly that the ceiling must be raised, but do you see any economics effects of even getting close to a default? And what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented.
Why? That's so
Would
un-American.
be an uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Chairman, thank you. Yeah,
Come on, Mr. Leeson.
Steve Leisman, CNBC. Can you
know who you are.
tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle, that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks and lots of data. And there was one page on Silicon Valley Bank, which talked about the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves are many banks are now are attending to liquidity and taking opportunity now, really since the events of early March to build liquidity.
Dropped a point of control to the tick.
You asked about the separation principle. Like so many things, it's very useful. But ultimately, it has its limits. I mean, I think in this particular case, we have found that the monetary policy tools and the financial stability tools are not in conflict. They're working well together. We've used our financial stability tools to support banks through our lending facilities, and at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry.
Can't hear you.
I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned. I think they did actually. They mentioned
on a case.
that they had taken regulatory
Like
action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
Control for ES 4143, really nice area so far today.
Hi, Chair Powell. I wanted to ask you, obviously, with the recent bank turmoil,
could've
we've
got a nice
seen
10-point ride.
multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry really since interstate banking, and before that even. It goes back more than 30 years. When I was in the government a while back, I think there were 14,000 banks. Now there are 4,000 and change. So that's going on. I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment
essence,
on
that's not me.
on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. When we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, a sufficiently restrictive stance. But I think conceptually, though, we think that interest rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it.
I mean, text
and
blew you up.
That's really all we can do. As I say, it does complicate. We have,
definitely seeing
a
some
broad
stocks
understanding of
kinda roll
monetary
over a
policy.
little bit
Credit
here.
tightening is a different thing. There's a lot of literature on that, but translating it
I'm not buying this dip yet.
into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's
Theo,
happening
you gotta
with
let the
lending.
price action gauge
There's
out,
a lot
right?
of data
So
on
you
that.
gotta take
and,
your profits
we'll, we'll
top of
factor
the
that
range.
into our decision making.
Look for some stabilization at the bottom of the range and buy.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now. But nonetheless, you will know that the summary of economic projections from the March meeting showed that at that point in time that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and
it's not good for the
make
pause
that, as I
narrative.
mentioned, it's an ongoing assessment.
A follow-up on credit, but could you give us a sense of what the SLUICE survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLUICE on May 8th in line with our usual time frame, and I would just say that the SLUICE is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Go to Nick.
Nick Tamaros with the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last two meetings, been seeing the effects of those moves. Why did the committee feel it was necessary to keep moving?
Well, the reason is that again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, what you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't with economic data. You can't. You've seen take inflation for it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that that a few months of data will persuade you that you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably, you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of, let's say, 1-year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what most people would, many people anyway, would assess as, the neutral rate. So policy is tight. And you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation, as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
Would you be okay with a prolonged 3%?
You know what? Let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process, and I think we're going to need to stay at this for a while.
How does the other side of the mandate, the jobs side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Matt. Hi, Chair Powell. Matthew Boesler with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet, wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in an expansion. So, yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that, if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that that wages are really the principal driver. I don't think that's really right.
Powell's mouth.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So, speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten, back to normal so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition where there's enough supply to meet demand, and then you're really back to full competition.
Rates.
That would be the dynamic I would expect.
Hopefully filter down.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it'll be the obvious things. It'll be readings on inflation. It'll be readings on wages, on economic growth.
I think it's
on the labor market.
I wouldn't touch it with your mother's money.
All of those many things. I think a particular focus for us going now over the past 6-7 weeks now and going forward is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards?
Somebody basically took the
and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing.
Yeah,
we'll be looking at everything. It's, again, I would just point out, we've
No
raised
range.
rates by 5 percentage points. We are shrinking the balance sheet, and now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more.
Who do you got the point of control at?
Due to
Mike?
what's happened. And we have to factor all of that in and make our assessment of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works
Mark
with
thinks
long
the
and variable lags.
IPOM is
So
turning
this is
around.
challenging, but we will make our best assessment. and
Mark,
that's-
I got to
that's
tell
what we're
you,
thinking.
you give
the idea of rate
tons of
cuts.
entertainment for our trading desk.
so,
I'm just letting you know.
We
appreciate it.
on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time.
This one you think there's going to be a
And in that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates. If you have a different forecast, and markets have been from time to time pricing in quite rapid reductions in inflation, we'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very
forecast
much
not to cut rates.
that inflation moves down. Particularly now, if you look at non-housing services, it really hasn't moved much, and it's quite stable. And so we think we'll have to demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney?
I love that.
Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing. We don't think now. It hasn't actually been growing. It moved up, it moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now. What happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on the overnight repo facility.
Really great move. Especially
that
once
is
it got
really
over
there
the
to help us keep rates where they're supposed to be, and it's serving that purpose very well.
To buy was when it covered around the 284. You'd be at 91 right now. Great.
Sarah Ewald-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Can you stop it?
Yeah, I would just say it's.
People don't listen.
I don't really think we should be. We shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And again, I would just say we don't. No one should assume that the Fed can do. Can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the regulatory, the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way: a large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system.
It's a pandemic for the financial
The only
system.
thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that it may just have been technology evolving. You know, we have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is identify those things and implement them. And that's kind of the only thing I care about and I feel like I am accountable for doing everything I can to make sure that happens.
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way. There were
It's never
three
good when you gotta think
large
about
banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period is an important step toward drawing a line under that period of severe stress. Okay. I also think we are very focused on what's happening with credit availability, particularly with what you saw in the beige book, and you will see in the sluice is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
Okay, Greg.
Thank you, Fed Chairman. Greg Robb from Market Watch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better.
We're still making mistakes.
And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations, and I do feel that I'm personally accountable to do what I can to foster measures that will address the problems. So on the Vice Chair for supervision, the place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as Vice Chair for supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel, my input privately, And that's, I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires. And, you know, but it isn't, I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and discussing, having an intelligent discussion about what's going on and why, and you know, that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors, and really in supervision has sole authority over supervision.
Just wondered if you had any regrets, or was there anything that, you know, decisions that maybe you regret now in light of what's happened?
I've had a few. Sure. I mean, you know, who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again, or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you know, you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. You know, that there's a sense that we're much closer to the end of this than to the beginning. That, you know, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close, or maybe even there. But that, again, that's going to be an ongoing assessment.
We're almost there.
And we're going to be looking at those factors
I'll take this
that we listed in to determine whether there's more to do.
I'm curious too how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
Good questions, by the way.
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly. And I think we can afford to look at the data and make a careful assessment.
And we'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that, you know, that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that. Then, you know, that we're going to revisit. It's pretty clear to me anyway, it's clear that we need to strengthen both supervision and regulations for banks of this size. And I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
Thank you. All right, Ty.
Well, what do you think, man? What do you think?
I don't know. I think there's a whole lot of fucking chop in the market that people have no idea what to think. I mean, look at the market, dude. It's just gross today.
It's completely.
That's
gross.
like that's not what I honestly thought would.
I gotta put my popcorn away because I'm not paying attention and I fucking getting chopped up. Yeah, it was choppy. It was choppy. I mean, I had a nice short off that 31 level or whatever it was, but this is pretty pretty choppy ass action.
Yeah.
Usually after a Fed meeting's over, you get a little pop up, at least we don't have to worry about it anymore, but there were some pretty hawkish statements in there.
Yeah. No, there definitely were. I mean, there was definitely some hawkish statements in there. Look, we're almost at the end, so.
Yeah. Well, I mean, it didn't seem like a rate cut is on the horizon.
Right. No, it didn't. No, at all. So.
Definitely, didn't make it sound like a rate cut was on the horizon. So, I don't know. I guess it's just kind of wait and see if the markets can kind of pick a direction here.
Yeah.
I would like to see a bounce off this level, but it doesn't look like we're going to get that. Does it?
Yep.
There we come on. What are we doing? I'm with Mark. I want to see like a wick down and then a wick right back up. What do you think?
Yeah, probably. I have no idea. I'm not playing this action, so.
It is just choppy action. So we had some good trading in there, and then the press conference hit, and it just became an utter disaster. So here's the wick. Let's see if this wick will kind of hold in here. But
all right. Yeah. Well.
Other than that, I don't. Yeah. So yeah. That's a good point. Somebody made the point that VIX is actually moving up instead of down. So that's something to consider. So I'm going to kind of filter this out. Well, I hope you guys enjoyed it. I mean, we had an interesting show. Now we're getting kind of a little pop here. What do you think? This would be nice. Well, we'll see.
Okay. All right.
All right, guys.
Thanks for tuning in, guys. Don't chop yourself up in this shit. Have a good rest of your day, guys.